So lending rates have been changing very quickly, and what we want to talk about today is how is that affecting commercial property values? We know the rates are moving, but how are banks looking at deals? How are they marking up debt? How are they pricing risk in the market? And how is that affecting valuation today? In this video, what I'm going to do is take you through a spreadsheet tool that we use here at our company to create a valuation for an income approach, but also for a sales comparison approach. But what's great about this tool is that we use a methodology that appraisers actually apply to develop the cap rate. So I'm going to talk about where cap rates have to go in response to lending rates, as well as how banks are looking at deals right now and pricing risk. So let's go take a look at the sheet now. Okay, so let's go take a look at what's happening with the lending market. As you know, Jay Powell testified before Congress recently that he intended to continue raising rates. Yesterday, he raised the Fed funds rates 25 basis points. We're now at 5.5% at the Fed funds rate level, and we seem to be headed to a 5.75% rate. So how is this translating into commercial property pricing and how banks are looking at loans? So what I recently did was I had a conversation with a lender that I work with and talked through a couple lenders actually, and talked through what's happening in the market, as well as how they're seeing things in underwriting deals. And basically what they described to me was you could have a 40,000 square foot building. And what I'm going to do here is take a 40,000 square foot industrial building that's generating $15 a square foot base rent. So that's going to be $600,000 base rent. Okay, so we got $600,000 coming in. I'm not going to put any operating expenses in because this is a net pass-through building. Typically, the lender's going to carry some capital reserves in here, so maybe we'll carry, say, $15,000 a year in capital reserves, and that's designed for basically a replacement reserve. So HVAC system blows out, and you have a savings account built up to deal with that. So we end up with a lender NOI, and the lender net operating income here allows us to then turn around and look at the financeability of this deal. And so I'm just going to go in and check. We're not going interest only. In fact, what we're going to do is look at a 25-year amortization. Now, the interest rate that we're going to put in here, this is what's going to help us get to the cap rate in the market. Now, what we've seen recently is with the rate run that the Fed's been pushing, the bank failures, banks have been nervous about commercial lending. And so basically what they're doing is they're building in a risk margin into their lending rates. And so they're going to, in Boston here, they'll go to the Federal Home Loan Bank of Boston. They can originate money at about 4.4%. That's how much they pay to borrow it. And so they take that money and they mark it up. Now, historically, the markup on that money might be 160 to 2.2 or 220 basis points. So figure, if just say 2% over that rate might be about 6.4%. But what lenders are doing now is they're starting to build more risk premium into the deals, and they're marking that money up 3% instead of 2%. So by doing that, we're now seeing a 7.5% rate being quoted in the market. Loan to values, they're still lending at 75% loan to value. But the big question then becomes, what's the cash on cash return requirement that the investor is going to be looking for on the deal? I can't imagine that the investor wants to make a smaller interest rate than the lender on cash on cash. The investor has the 10-year treasury at about 4% right now. So if we mark that up with risk premium for equity, which sits above the debt in the capital stack, it's higher risk money, that money should be earning a cash-on-cash return that's higher than the interest rate. So let's just say I go in here and I say we want to make a, we'll say 10% cash-on-cash return. We're paying the bank 7.5%. We're going to generate a 10% cash-on-cash return on equity. What that tells us is that building, that 40,000 square foot industrial building that we're buying is now at a 9.15% cap rate. And that building is coming in with a valuation of $6.556 million, just based on this income capitalization approach. So this is how cap rates move as the interest rates are moving, and as banks are pricing money higher than they used to. It's going to push on cap rates even harder to go up. Now, one of the things that one of the lenders said to me was he's anticipating the rates will come down a little bit, so you'd be better off going along on this interest rate and then going back to the bank to buy down the rate as the rates start to come down. And as you do that, you start to free up more and more cash flow. Whether the bank's going to honor that or do that later, there's no guarantee that'll happen. But that was his rationale from the lender's perspective on how to manage this rate run. So if we look at this and we compare this 40,000 square foot building to what was trading even 24 months ago, that building might have been, we're going to put it in 40,000 square feet, that might have been in the $200 to $300 a square foot price range. You might have seen someone come in and pay $250 a square foot for that building. We're looking at that building now for that same rent at $15 a square foot, and you can see the income capitalization is at $6.5 million. So let's go back in time. I'm going to lower that interest rate back down to, let's call it just 4.5%. We're going back in time, and you can see the income capitalization growing on that building. And when we were down in that 3.5% rate environment, that building was financeable at $8.5 million. But if we were to go to the cash-on-cash return, which was also acceptable at a lower number, okay, we get down to like 7%. You can see how the alignment started to show up here in the income approach. So we're about $9.6 million. Our sales comparisons at about $10 million. That market's aligned, okay? More or less aligned. You're going to be able to buy that building, finance that building. But as these rates started moving and they started to climb very rapidly, the one thing that can't shift that fast is contracted rents. You just can't change contracted rents that fast. So as that's happening and buyer expectations are changing, they're just right behind the banks here on what they want, you can see here that the bid-ask gap starts to emerge in the market. So if you want to sell a deal, you've got to be very aware of what the market's doing, so we can get the bid-ask gap closed and get this income approach lining up with the sales approach. So the key here is the market's changing so fast that seller expectations will lag that, because we tend to look backwards at what's happened near us, and we value our assets based off of what's going on or what we know about. But if we look forward at what's happening, the lending market is changing so quickly that it's continually putting pressure on valuations in the market. So it's very, very, very important that if you are underwriting and you're determining what your valuation is, that you go through an exercise like this to figure out, where the bank's going to come in, where they're going to finance, as well as where some of the comps are, because the comps, as these rates are moving, they start to become almost obsolete pretty rapidly. So if you're interested in getting an evaluation done on your property and you want to figure out how best to position it in the market so that you can find the right buyer to pay the right price and be assured that you're going to close on your sale, go to our website, mansardcre.com. You can go to the top right corner. There's a button there that says request a consultation. Just click that, You can fill out the contact us form. One of our experts on our team will be in touch with you right away. Or if you want to just call the office, you can do that too. You can dial 617-674-2043. Hope you enjoyed the video. If you like videos like this, please hit the subscribe button, get that notification bell turned on, and then every time we publish, you'll get notified that we put something new out about the market. Thanks.